Welcome to the High Yield Real Estate Investing Podcast, a podcast focusing on multifamily investing in short, easy-to-digest 5-minute segments.
Hi, I'm Brooke.
And I'm Dan.
Were you around in 2008? I bet you've heard of Fannie Mae, Freddie Mac, and possibly Ginnie Mae. Ever wondered who or what these entities are? Maybe you have. Have you ever wondered what the mortgage market looked like in the early 1900s? I bet you haven't. In the early 1900s, home mortgages were often short-term with a balloon payment required at the end of the term. In the Great Depression, up to a quarter of the mortgages in the entire country defaulted, with those homes being repossessed by the banks. Why were those home loans short-term and so very different from the 30-year loans that are the industry standard now? Well, if you're a small regional bank with limited assets, you'd run out of money awfully fast if you held on to each mortgage you issued and very slowly got your capital back over a 30-year period. As a result, these banks wanted their money back faster so that they could lend it out again and again, and therefore they introduced a shorter term.
Luckily, the federal government stepped in with a plan to create a secondary market of companies that will purchase these mortgages from the small regional banks, or anyone really, so they can get their capital back and lend it out to the next person wanting a mortgage. That's essentially what happened in 1938 when Congress created the Federal National Mortgage Association, colloquially known as Fannie Mae. They were a product of the Great Depression and the New Deal. Their existence guarantees liquidity in the secondary mortgage market by buying mortgages from the lender who issued them to you. They then package those mortgages together into securities that investors can buy. You can buy stock in the company as well. If you're curious, look up the ticker FNMA. In 2019, Fannie Mae had $3.5 trillion in assets, so they're a very large company.
Freddie Mac is actually the Federal Home Loan Mortgage Corporation. It was created in 1970 in order to encourage more liquidity in the secondary mortgage market. Freddie Mac also buys mortgages on the secondary market, packages them into securities, and guarantees their return to the investors. You can also buy stock in this company for about the same price as Fannie Mae. In 2019, they had $2 trillion in assets trading under the ticker FMCC.
Ginnie Mae, or the Government National Mortgage Association, is an offshoot of Fannie Mae created in 1968. They only deal with VA, FHA, Indian Affairs, and rural development loans. They also offer a mortgage-backed security. Only Ginnie Mae is wholly owned by the government. While they don't buy up mortgages like the other two do, they are the only ones that can claim their product is backed by the full faith and credit of the U.S. government.
If you're curious what we mean by a secondary market, think of Craigslist. Let's say you buy a brand new Toyota Corolla from the dealer, and then after 10 years, you list it on Craigslist and sell it to some guy on the internet. Craigslist is the secondary market that makes your sale of the used Corolla possible. For that matter, Auto Trader, the newspaper's for sale section, or any for sale sign on your car all act as a secondary market for used automobiles. You'll also, of course, need a willing buyer.
So what are these mortgage-backed securities? Well, after Fannie or Freddie buys your loan, they'll then package it along with many others into a mortgage-backed security and then sell those to investors. But what happens if you stop paying your mortgage? Well, that's bad for you, but not the investor. Each of these three companies guarantees to the investor that the principal and interest portions of your mortgage payment will be made on time. That makes the investors happy and secure they won't lose their money. And generally, these investments are thought of as a safe bet. What happens to Fannie or Freddie if you don't pay your mortgage? Since we just told you that they guarantee to the investor that you'll pay your mortgage, those funds you didn't pay have to come from somewhere. Well, now we're delving into the world of Wall Street derivatives with something called a credit default swap. Think of it like an insurance policy that Fannie buys in case you don't pay your mortgage. Sound complex? Well, it kinda is. If you want to understand this better, go watch the movie The Big Short, and you'll have a much better idea of what happened during the housing crash in 2008.
Fannie and Freddie aren't the only companies that can buy loans on the secondary market. Anyone with the capital can do that. There are real estate investors who carved out a niche for themselves by investing in mortgages, also called notes. Promise to pay can be bought and sold. This includes mortgages, car loans, medical bills, or maybe that cell phone bill you didn't pay 10 years ago. If you've had a mortgage for any length of time, you've probably had this experience yourself.
This has been part 1 in a multi-part series on loans. In the next episode, we'll talk about some terms you need to know and what kind of loans you as an investor will want to know about. Thanks for listening. If you want to learn more, go to highyieldre.com. You can also email us at info@highyieldre.com.